All right, welcome back to the deep dive. Today we're going to be taking a close look at Toro, TTC, the ticker symbol.
Yeah.
Earnings call came out pretty recently, so this is your chance to catch up on everything Toro.
Yeah.
Without having to listen to the whole boring call.
Exactly. We're going to try to break down, give you the highlights, the good, the bad, and the ugly.
Yeah, and maybe some interesting tidbits in there for you. So first quarter results, they came in with net sales just under $1 billion.
$990 million to be exact.
I mean, that's a pretty good chunk of change, right?
Yeah. No, it's definitely a sizable number.
And what's interesting is their professional segment actually saw some growth.
Yeah, that was one of the bright spots for sure.
But then the residential side, that was a little bit softer.
As expected, though. I mean, they had kind of hinted at that in previous, calls and guidance.
Right. And earnings per share, the adjusted diluted earnings per share came in at 65 cents.
Up from last year.
Up a bit, yeah.
Which is good to see.
And I guess looking ahead now to the full fiscal year 2025, it looks like they're keeping their guidance pretty much the same. Yeah,
they're sticking to their guns. Net sales and adjusted diluted EPS guidance all unchanged.
So steady as she goes for now.
Exactly.
All right. Well, what about the short term? What are we looking at for Q2?
So for the second quarter, they're basically saying total company net sales should be pretty similar to last year. Maybe some slight pluses and minuses between the professional and residential segments.
Right.
And they're thinking adjusted diluted EPS might be a tad lower than last year.
Okay. So let's break it down a little bit. We got to get into the nitty gritty.
Let's do it.
Let's start with the professional segment because that seemed to be like the star performer here.
Yeah, for sure. So net sales for the pro side up 1.6%, hit $768.8 million. Pretty impressive. And a lot of that growth driven by, golf and grounds care equipment.
Yep.
Strong demand there.
It seems like golf is, obviously it had this huge resurgence during the pandemic.
For sure.
But it seems like it's sticky. People are still out there on the course.
Yeah, absolutely. And you see it not just in participation, but in, equipment sales and these courses needing to upgrade and maintain their facilities.
Yeah.
So it's definitely a good sign for Toro.
Yeah. And then they also mentioned something about zero-turn mowers.
Yeah, they saw increased shipments there too.
Yeah.
Which I think just, reflects pretty healthy demand.
Okay.
Coming through the channel, their distributors and dealers.
Yeah. And were they able to raise prices at all?
Yeah, they talked about that. Net price realization was positive.
Okay.
Basically means they were able to get a little bit more for their products compared to last year, so that helped.
All right. So not all sunshine and roses, though.
Right. They did mention lower shipments of those compact utility loaders, which they're kind of attributing to, maybe last year the channel kind of loaded up.
Okay.
And with all the, economic uncertainty, maybe people are being a little cautious.
Right. So that's kind of like
a little bit of
a watch out area.
Yeah, exactly. Something to keep an eye on.
So how did all that shake out for their profitability?
Well, despite that little hiccup with the loaders, the pro segment earnings actually jumped 13%.
Oh, wow.
To $127.2 million.
Okay, that's significant.
Yeah, not bad at all.
Not bad.
And their margins also saw a nice bump, went from 14.9% to 16.5%.
So they're getting more efficient. Or they're at least, pricing things.
Yeah, it's a few things working together. They're definitely seeing some good net sales leverage, which basically means higher sales are covering their fixed costs better.
Okay.
They also had a favorable product mix, maybe selling more of the higher margin stuff. And then they also seem to have achieved some, productivity gains. Of course, they're still dealing with higher costs overall.
Right. Of course. Yeah. Everyone is. All right. Well, let's flip over then to the residential side. What's the story over there?
Yeah, so residential, a bit of a different story.
Okay.
Net sales came in at $221 million, down from $240 million last year.
Okay.
But we got to remember they sold off that Pope Products business.
Right.
And that was about $7.5 million in sales last year. So that's definitely impacting the year-over-year comparison.
So not quite a straight apples to apples comparison.
Exactly.
What else was driving that decline?
Well, they definitely shipped fewer snow products this time around.
Okay.
And that's kind of a two-pronged thing. I mean, one, retailers were still sitting on a lot of inventory from last season.
Right. Makes sense.
And two, snowfall was below average in a lot of key markets, so less demand.
Yeah.
They also saw lower shipments of portable power products.
Interesting. Okay.
And they had to get a little bit more aggressive with promotions and incentives this time around, which, can impact the top line.
Right.
So a bit of a mixed bag there.
So market conditions and then maybe some, strategic decisions as well.
Exactly.
Any bright spots in the residential segment?
Well, they did see an uptick in shipments for both zero-turn and walk-behind lawnmowers.
Okay.
So it looks like their core lawn care business, in the residential side at least, is holding up okay.
Okay. All right. So with all those factors in mind, how did the residential segment's bottom line look?
Well, earnings were down to $17.2 million compared to $23.5 million last year.
Okay.
And margins took a hit as well, went from 9.8% down to 7.8%.
Ouch.
Yeah. And again, it really boils down to those higher costs we talked about,
Right.
the increased promotional activity eating into profits, and then just the mix of products they sold wasn't as favorable this time around.
Mm-hmm. Right. Okay, well let's zoom back out now. Look at the big picture for the whole company.
Yeah.
How are they looking overall, financially speaking?
So overall, both their reported and adjusted gross margins dipped a bit compared to last year, ended up at 33.7% and 34.1% respectively.
Okay.
Which, like we've been talking about, mainly due to those higher material costs and just those manufacturing expenses.
Right.
They did try to, offset some of that through operational improvements, but, there's only so much you can do.
Right. And then what about, overhead costs like sales and admin, all that good stuff?
So SG&A as a percentage of net sales did creep up a little bit compared to last year, but their adjusted operating earnings as a percentage of net sales actually saw a slight improvement, got up to 9.4%. So, maybe that's a sign they're managing things pretty well overall.
Yeah. I mean, you gotta watch the pennies, right? Especially in this kind of environment. Now, I remember seeing something about them buying back some of their stock.
Yeah, they repurchased $100 million worth of shares during Q1.
Okay.
Which follows, a much bigger buyback last year, almost $250 million.
So they're putting their money where their mouth is.
Yeah, it definitely shows some confidence.
All right. Well, let's switch gears a little bit and talk about some of the, the strategic stuff. They mentioned this AMP initiative. What's that all about?
So AMP stands for amplifying maximum productivity. Basically, it's their big push to streamline operations, find efficiencies. And they reported $50 million in annualized run rate savings just in Q1.
Wow.
Which brings the total to like $64 million so far. And they're aiming for $100 million in savings by fiscal 2027.
That's ambitious.
Yeah, but they seem pretty determined.
So where's all that? Where are they finding all these savings?
Well, in Q1, it was mainly headcount reductions.
Okay.
But going forward, they're looking at optimizing their supply chain. Finding better deals with suppliers and just, squeezing more efficiency out of their processes.
All right. And I know they're big on, innovation and all that. Anything new and exciting on that front?
Oh, yeah, tons. They're really pushing the envelope with their robotic solutions, especially for golf courses.
Yeah.
They've got this new autonomous mower called the Toro Turf Pro. And then there's the Range Pro, which is a robot that picks up golf balls on the driving range.
All right. So they're solving for the labor shortage on the golf course.
Exactly.
So.
And it's not just robots. They're also making big strides in smart connected solutions.
Okay.
Which basically means, using data and technology to make everything run smoother.
Yeah.
They've got this Intella 360 web-based platform, helps manage equipment fleets, and their Lynx Drive platform for controlling irrigation systems remotely. All very cutting edge.
Yeah. So it's like, giving golf course superintendents more data, more control, all at their fingertips.
Yeah, exactly. And then they're also getting into the whole soil moisture sensing game.
Okay.
They partnered up with this company, Toro, and they're launching the software called Spatial Adjust, which basically uses super detailed soil moisture data to fine-tune irrigation.
Okay, so they're trying to be more efficient with water usage.
Yeah, definitely. I mean, water conservation is huge.
Yeah.
Especially for golf courses.
Makes sense. All right. Well, it looks like they're also branching out a bit.
Yeah, they made this interesting acquisition, Procastro Services USA,
Okay.
which is all about, inspecting and repairing underground pipes, water, wastewater, stormwater, that kind of stuff.
Okay. So that's a different area for them. What's the thinking there?
Well, they're really bullish on the long-term prospects in underground construction. All the stuff with data centers, energy grids, aging infrastructure. I mean,
Right.
it's a massive market.
Yeah, there's a lot of pipes in the ground,
Exactly.
and a lot of them are probably pretty old.
Yeah. And they need to be replaced.
All right. So it sounds like they've got a lot going on.
Yeah, for sure.
Yeah.
A lot of moving parts.
What's the outlook then? What are they saying about the rest of the year?
So they're still sticking with their full year guidance. Net sales growth, 0 to 1%.
Okay.
Adjusted diluted EPS in the range of 4.25 to 4.40. But that's, generally not factoring in most of the new tariffs that have been introduced this year,
Right.
except for the ones on China imports.
Right. Okay. And then how about, profitability for the full year?
They're still expecting improvements in both their adjusted gross margin and their operating earnings margin
Okay.
for the full year. And they're even thinking both residential and professional segments will see higher earnings margins compared to last year.
Okay. So even though the residential side had a bit of a tough quarter,
Yeah.
they're still optimistic.
Yeah, exactly. For the long term.
Okay. And any specific predictions for Q2?
So for Q2, they're thinking total company net sales pretty much flat year over year. But within that, professional segment sales should increase in the low single digits, while residential, they're expecting a decline in the mid single digits.
Okay.
And then for adjusted diluted EPS, probably a little bit lower than the $1.40 they reported last year.
Okay. So it's a mixed bag, right?
Yeah, it really is.
Some areas growing, some areas kind of,
Holding steady,
Yeah.
or maybe even, pulling back a bit.
right.
Yeah.
Right. And they mentioned something about all the macro uncertainty out there.
Yeah, I mean, no one can ignore that.
Right.
There's a lot of stuff going on. Economic conditions, consumer confidence, geopolitics, all that.
It's
It's a wild world.
yeah. And then you throw on those tariffs, potential changes in regulations.
Yeah,
It's a lot to navigate.
it really is. But they seem pretty, confident in their ability to adapt. They said they're prepared to adjust their operations, their pricing, all that as needed. And they did mention that most of their professional segment products are made in the USA,
Whoa.
which helps limit their exposure to those tariffs.
Yeah. Smart move. All right. Well, I think we've covered a lot of ground here,
We've been through it all,
from the numbers to the strategy, the outlook, the whole shebang.
the whole 9 yards.
But it's time now for one of my favorite parts of the show, the This Is Not Financial Advice segment.
All right, fire away.
So this is where we, let our imaginations run wild, come up with an outrageous but plausible trade idea.
Love it. Let's get crazy.
All right. Well, we were just talking about how Toro's going all in on automation and robotics. And at the same time, we've got this labor shortage
Yeah.
across so many industries. So here's my thought.
Hit me.
Long position in a robotics ETF, one that tracks all those companies doing the cool automation stuff, paired with a short position in an ETF that follows, traditional labor-heavy service industries.
Interesting. Like
Restaurants, hotels, maybe even some logistics companies.
okay, I see where you're going with this.
Basically, the bet is that the companies embracing automation, like Toro's doing with the golf, they're going to be the winners.
Yeah, because they're less exposed to those rising labor costs and all the headaches that come with finding workers.
Exactly. So it's not just about Toro itself. It's about this bigger trend towards automation.
A bet on the future of work.
Exactly. But, and this is a big but,
Of course, always a but.
this is purely hypothetical.
Yeah.
Just a thought experiment.
This is not financial advice.
Definitely not. Do your own research.
Yeah.
Understand the risks. Talk to your financial advisor if you have one. Don't just go out and, trade based on what you heard on this podcast.
Absolutely. We're just here to spark some ideas, get the wheels turning.
Exactly. All right. Well, that wraps up our deep dive into Toro. Hope you enjoyed the ride.
Yeah, it was a good one. Well,
Learned some new things, got your brain stimulated a little bit.
hopefully.
So until next time, keep those tickers ticking.
And we'll catch you on the next deep dive.